So we are at the midpoint in the afternoon. I hope everyone is getting some coffee, some Cuban coffee. So the next panel covers opportunities and risk with yield products, understanding relationships between DeFi and CeFi. Our moderator is Yuri Ferruccio, the co-founder of Bril Finance, which is one of our wonderful sponsors. Ladies and gentlemen, please grab a warm cup of coffee and give a warm round of applause to our next panel led by our moderator, Yuri Ferruccio.
Good afternoon, everybody. I hope you got your coffee, because I feel like whenever you get to the DeFi panel in one of these things, everybody goes to sleep. Sort of like all these people who presumably made a lot of money doing things that I kind of don't understand, talking about nerdy things. Obviously, right now, we're at a point in the market where I think it's particularly interesting to talk about decentralized approaches to finance and yield creation, because we've seen so much of these centralized approaches run into trouble fairly dramatically over the last, let's say, half a year. So we've got a lot of different types of folks who are involved in everything from strategies to infrastructure, who are going to help us explore kind of what is this thing called yield in the context of crypto, and where did it come from? And then where are we at right now with it, and where's it going? But before we do that, I think just so that everyone has some context about the multiplicity of views that our great panelists have, why don't we do a very, very quick elevator introduction for each of us. And I'd like you to talk a little bit about what you have done that's kind of brought you here, as well as what you're doing, just so everyone has an idea of kind of where your biases are. Why don't we start at that side?
Amazing. So everybody, Alex, thanks a ton for hosting us. Thanks to the Web3 guys for putting this all on. I come from an investment banking background, and I really got into finance in the first place to try and match people with money with people who need money. And from a very kind of academic perspective, and realizing when you get into the TradFi complex and infrastructure, there's way more fat and waste and friction than there needs to be. And obviously Web3 and blockchain is the one way that we can potentially start to reinvert and change that. So I founded a venture capital company and have really been building a lot in the yield and stablecoin and cross-border payment space recently, including a product that we launched today. So super excited to dive into all of this fun stuff, what's sustainable, what's real, what's not, and where we kind of go from here.
Hey everyone, it's good to be here. My name is Bryan Gross. My background, I basically made a financial services company for Amazon, Amazon Marketplace. Lending to millions of small businesses across Europe. After that, I joined IBM and worked on blockchain from the inside with enterprise. Once we kind of realized that we weren't going to change the internals of the financial system directly, I went into DeFi, and I look forward to exploring the relationship between the two this afternoon. Thanks for having me.
Hi everyone, my name is Rena Shah. Thank you so much for having me. I come from probably a little bit more of a different background than the folks on the stage. I am a petroleum engineer. I started off my career in the oil fields out on the Gulf in the rigs, and was mainly working on the production side of oil, but then transitioned to the commodity side on the trading desk, and that's kind of what spurred me into crypto, which took me to private equity and such. Right now running strategy and ops at Trust Machines. Prior was an executive at Binance US.
Hi everybody, I'm Stefan. I got into Bitcoin because I was working with a lot of software engineers, and one of them wanted to get paid in Bitcoin. And so that's how I got into this at about 2012. I then sort of was immediately enamored by the technology and the immediacy of peer-to-peer electronic cash system. What does that look like? And that just captured me. I became the CEO of Bitcoin.com, grew that to 20 million wallets, and 500,000 merchants where you could actually go and pay with Bitcoin and Bitcoin Cash and Ethereum. You could go to coffee shops and pay for your food, your drinks, your coffee, etc. Since then, I'm now the CEO of Laguna DeFi, and what we do is we build an Oracle service for real-world asset and bringing that on-chain, and then we're building out a lending protocol associated with those real-world assets.
Yeah, hello everybody. John Devine here. I'm from BlockFills. Before crypto, I was in traditional finance. I was a market maker for precious metals, interest rate swaps, energy markets, etc. I got super into Bitcoin just from that background in precious metals, and I ended up being fortunate enough to join a Ethereum hedge fund. It was actually one of the leading funds at the time I joined them. And I was an execution trader for this fund, and one of my counterparties was BlockFills. And now I've joined BlockFills. So what we do is we're an institutional market maker. We do spot liquidity provision for exchanges and for other OTC desks. We also do options liquidity provision, futures markets, lending and borrowing markets, and structured products.
And just so you know where I'm coming in from, I got my start in traditional finance and technology for D.E. Shah, a hedge fund in New York, and for JD.com in China. I was actually helping to found JD's AI division back in 2016 when I got into crypto there. And I had about 6 months before China banned crypto for the first time, where we had a lot of fun kind of exploring that. So I've been involved in the space since then, building and investing, and recently spent about a year at Binance as VP for business development. But before that, I co-founded a company called Bril, which focuses on creating a better way to create a crypto sort of yield portfolio using best practices for risk management from traditional finance, and also in a way that sort of creates yields which are what the industry calls real yields or sustainable yields, which I think we'll address here in a little bit. I guess just to get a sense of where everybody's at, how many here knows what DeFi is? Just raise your hand. Okay, that's a fairly good amount. How many people here have executed personally a DeFi transaction using Aave or Compounder? Okay, that's a smaller number. I would say less than half of the room has actually interfaced with DeFi, maybe a third generously. So before we dive into all the nerd details that we wanted to dive into, I'd love for somebody on the panel, maybe Alex, to briefly just define what is DeFi and sort of what is yield. What are we talking about here?
Sure. And this is going to be a very simple answer to it. And I think we've created incredibly complex, relatively sophisticated institutions within the traditional finance world. We've had hundreds of years to evolve them. We generally have pretty terrible technology, so we've come up with some complex and interesting ways to kind of get past that technology. But we've created a pretty efficient market across the entire world. Now what we've done in DeFi is we've started pulling out bits and pieces of that market, and instead of them being run by according to a series of business processes within a gigantic financial institution of, hey, here are generally our rules, here are our underwriting standards, here's who approves this, here's who approves that, we've taken those fundamental underlying business models and we've made all of the business processes code. So whether it's securities lending, which is basically all Aave, Compound, all of those platforms are doing, whether it's exchanges, so Uniswap v3, the DEXs that we have, whether it's AMMs or liquidity provision in general, those are all just things that were done by traditional finance before according to a set of rules that we've pulled out and made now automated. And that has benefits and pros and cons. In traditional finance, when something goes weird and the rules are off, you have contingency mechanisms. You have ways to overcome that. You have ways to change it. You have ways to say, whoa, that's not what we wanted. X, Control Z, let's undo that. Whereas in DeFi, you don't. But in traditional finance, you also have fraud risk. You have people who are selfishly motivated. You have all of these kind of individual human aspects to it. And in DeFi, you don't necessarily have that either. So all it really is a series of traditional finance activities and opportunities that are done in an entirely automated way. And that's a simple evolution, but it's incredibly powerful as well. When you can truly make something machine speed and connect it to all of these machine speed webs of commerce, you can really get it past where we have it in the traditional finance world into this unbelievably cool world of DeFi. But there's lots of challenges, and this is why it's such a cool industry to build in.
Thanks, Alex. So that's DeFi. What is yield in the context of DeFi? I think it's just worth very, very briefly getting a little bit specific about that. And I want to ask John here to maybe walk us through, where did yield come from? and sort of how have we gotten to where we are today in terms of all these platforms generating so-called
Sure.
yield?
Yeah, so yield is income generated against an investment. So what does that mean? Well, really the way yield in crypto began was we had Bitcoin miners, and Bitcoin miners were being rewarded Bitcoin via the block subsidy, but they had an input cost. They had electricity costs, they had employees, et cetera, that they had to cover, and those input costs to generate Bitcoin block rewards were not payable in Bitcoin, so they needed dollar liquidity. So really, yield in crypto, broadly speaking, started with dollar lenders lending to Bitcoin miners in an over-collateralized fashion, meaning I lend dollars, the Bitcoin miner over-collateralizes that loan with Bitcoin, let's say 80 LTV, loan to value. In that case, it would be I lend $1 million, the Bitcoin miner gives me 1.25 million worth of Bitcoin to hold on to as collateral, and then I get a yield on that dollar loan to the Bitcoin miner. That's really where all of this conversation going forward comes from, and that is a simple way to think about what yield is.
Can I just jump in with one additional thing there? Taking kind of the securities lending mindset, there's a ton of arbitrage in the crypto space. And that's where a lot of these really liquid yields come from, where there's very quick trades that happen, whether it's the futures basis trade, whether it was the GBTC arbitrage trade that very quickly turned into a LCTR type situation. But that's where a lot of this liquid yield comes from. And in its best form, that's a very, very natural, normal, healthy, fundamentally valuable trade. So I think when we look at kind of going forward and how we built the structures of the yield industry, acknowledging that trading, market making, arbitrage is a fundamentally valuable part of the crypto ecosystem, and that's where a lot of these yields come from as well, especially the liquid ones.
So then that's great. Fast forward to kind of where we are today, right? This started with Bitcoin miners. Now, you probably, if you weren't deeply in this space, you heard about people getting 10,000% APY yield on some kind of crazy product for DeFi in the height of the what's called the bull market. Then, of course, over the last 6 months or so, we've had some spectacular collapses due to all kinds of governance problems and the like, with things like Terra and the whole centralized lending industry. Like, what are we talking about in terms of yield creation today? What are people doing to go get yield?
So yield came about because, largely through this technology that was invented, or this new infrastructure, automated market makers. And what are you doing? You're interacting. Yield is being generated. I don't give it to another entity, another business that's going to generate a return and pay back. I'm giving it to a smart contract. And as I lock it into that smart contract is then working on behalf of the machine, but you're providing liquidity to the market. And so as a result, that you're getting a share of the revenue that liquidity that you're providing, you get that in return. And that is the yield that you get today. Some people offer more return than others. Certain pools of liquidity offer different yield because of the demand or the supply associated with that. And that's basically what we've relied on. We've come to rely much more on code, which is transparent. Anybody can see it, and you can see any movement of those smart contracts at any point in time. And they are governed by code, and that governance can be verified. You can compile every smart contract because 9 times out of 10, they're open source. And if they're not open source, you tend not to trust them and you wouldn't interact with them. But you can compile them and you can see that they are working in accordance to what they're stipulating or not.
So that, I think, segues naturally into some of the advantages that DeFi creates, right? It's sort of cost reduction. It's potentially an increase in reliability, right? If you can potentially rely on code, more transparent code more effectively than on large non-transparent organizations, whether they're large centralized exchanges or traditional companies. Are there any other advantages that we would want to highlight as kind of fundamental innovations that we believe that DeFi either has already started to realize or has the potential to bring?
I would say the composability of all the smart contracts on DeFi. In centralized lending for CeFi, you're trusting a counterparty and taking that counterparty risk, but at least in DeFi, to the point of you're trusting smart contracts, and as these contracts are audited, battle tested, vested, going through the variety of different measures that people take on a securities protocol analysis, but then even taking a step further of open source libraries on virtually every change to pull from to get best practices. Theoretically, smart contract risk will eventually go to zero, and you're redacting the human error of, did my portfolio manager make the right call or not? Instead, it's completely visible. The other idea is, like, at least with DeFi pools, everything is out there on chain. You can see the interest rate, you can see who's borrowing, their reputation is on the line, and everyday folks participating in governance can call them out and be like, why are you doing this? How are you assessing your credit worthiness? And have it fully open for people to see in plain sight, as opposed to the black box of CeFi.
Did you want to add something?
Yeah, oh, sorry, go ahead.
Yeah, and one more thing if you think about the most interesting part of Bitcoin, essentially somebody said, if you get Bitcoin every block you solve, maybe you'll value it, maybe you'll change what you do, and we've seen these huge mining operations come about. DeFi is a fundamental layer of organizing human activity with more complex actions. You can put all sorts of rules in there. And so as people can see, they can verify how they'll get paid for what they do. It will expand into more and more businesses across many industries. But it can't be in a normal exchange. It has to be on chain or it doesn't work. So I think that's what I'm most excited about next.
And just to build on that, and back to one of your points earlier, about these 10,000% like just weird yields that make no sense, and it's both sort of a blessing and a curse of DeFi, because it's Lego blocks. You can build stuff on top of other stuff, underneath other stuff, beside other things, and you can create these incredibly innovative, intricate webs of money that flows around, all automated at machine speed. And when in the bad sense, you have some level of fundamental underlying value where you're lending to an arbitrager or whatever, and then you're stacking on top this yield farming mechanism where you earn tokens, you go and turn around and monetize those, you take what you do from that and you go into another platform, and you kind of stack all of these weird things together where you have maybe this like 2 or 3% natural yield or real yield at the bottom, and then all of this crypto chaos that kind of gives you these like crazy numbers. And so in an experimental way, that's cool, that's interesting. These are all these new forms of commerce that we're kind of playing around with. And on the good side of that, when you start to sort of, especially in the wreckage of everything that's gone on right now, when you start to layer on, okay, this tail risk that we have for smart contract risk right now, okay, I can flick on or off a decentralized insurance policy when that tail risk starts to become larger than I'm interested in holding. I can turn on and off tranching mechanisms where my yields are now protected by a junior tranche, and I can do all of that on a block by block basis. So every asset I have can be constantly optimized at all times. And that's a really fundamentally interesting innovation that you absolutely cannot have in traditional finance, where you have T+1 or even T+ end of day settlement. So when you start to look at all of the infrastructure and the composability on this like block by block basis, it's every one individually is a slight evolution. Put them all together and we can create entirely different structures of commerce that are fundamentally unable to be replicated by traditional finance. I think that's really where a lot of us get excited about it.
Yeah, I think you guys have pointed out a lot of really interesting potential efficiencies. I'll just highlight a couple of use cases that I looked at pretty closely when I was at Binance and I'm still interested in. One has to do with the fact that smart contracts are very simple in the singular, but you can do very complex things with them when you stack them on top of each other because they're modular. And one of the things that people are looking at using this to do is to actually create markets for trading fractionalized rights for songs. Every single major rights holder, every single major record label out there is actively exploring this. And this is interesting because if you think about it, music is like the most utilized art form out there, I think, probably, right? Like we listen to music more than we watch TV, more than we watch movies. It's a huge part of our lives. And when you think about the value of making something like this tradable, there's also a big benefit because it's very understandable and comprehensible by retail users, and there's also, I think, inbuilt into this a lot of volatility because the value or the demand for a song can go up and down very quickly based on publicity, based on events related to individual singers and stuff like that. And I didn't get this, to be honest, when I first started talking with record labels, but then I dug into it more, and the kind of D. Shah part of my brain realized that like there are going to be entire quantitative hedge funds that do nothing but arb these marketplaces inside, the sort of like rights things. And I think my takeaway was I started to see how it's the automatability and the stackability of smart contracts which can help you to build in financialization to new parts of human activity in really, really interesting ways. Another thing that is true right now, may change as regulation starts to engage with DeFi, is that it's much easier to build a global market using DeFi than it is using traditional securities, because you have all of these passporting laws with securities where you have to go and essentially work on a bilateral basis between two different countries that have very specific requirements if you want people in one country to access securities in another country. This is very relevant for global carbon markets, for example, because that's a global problem with a global level of concern, and you see a huge amount of interest in using decentralized rails to make it possible for there to be more participation in terms of pooling resources and trading assets related to climate change fighting. This is the positive side, though. I mean, the flip side is, right, you can sort of, true or false, the recent great successes of Sam Bankman-Fried and FTX prove that DeFi has already made it and is ready for the big time. Or to flip that,
I'll say false on that. I think that this is an absolute example of just criminal activity that should not reflect on anybody who's participating in crypto ecosystem. We need to stop trusting 29-year-olds with billions and billions of dollars in due diligence on counterparties. I think this SBF conversation, although it's unfortunate that many people lost money, is an absolute joke, and it shouldn't be a focus of this industry at all. I'd like to branch just real quick. When we're talking about yield in DeFi and CeFi, I'd like to refocus on, what real yield is. And if you have this collateral asset, Bitcoin or Ethereum, you should pay attention here real quick. So real yield comes from liquidity provision or optionality, all right? If you own Bitcoin, Bitcoin's a collateral asset. You can sell optionality against your Bitcoin. What I mean by that is a call option. A call option is the right to buy an underlying asset at a predetermined strike price. You own Amazon stock, you can sell covered calls against Amazon stock. You own Bitcoin, you can sell covered calls against Bitcoin. This is real yield. There is a buyer for the optionality to own your asset at a higher strike price than the current traded price. Bitcoin's trading at 16,000 right now. I can sell December 30th, 24,000 call options against my Bitcoin, and I can annualize north of 20%. That's real yield through optionality. You have dollars in your portfolio, you can sell put options. Put options obligate you to own the asset at the strike price. So Bitcoin's trading at 16,000. I have dollars, I want a dollar cost average every month. Instead of buying the spot market every single month to DCA, I can sell puts. Like right now I could sell the 12,000 put or the 11,000 put, which obligates me to own the asset at that strike price, and the buyer of that put option will pay me for that optionality. That's real yield. And this is also coming to DeFi. We're seeing this with DeFi option vaults, covered call vaults, covered put vaults, covered strangle vaults, which are selling calls and selling puts. This is the maturation of crypto. We're going to get away from all this token speculation, and we're going to come back to reality and find yield through liquidity provision and optionality.
And I think that's the brilliance of crypto, right? I mean, what it's done, it's built the infrastructure rails to enable a lot of these products that have already been built in the traditional finance world. There's a whole bunch of experience that's been created, products that have been tried and tested that can now be put on new rails that take out a lot of middlemen, take out a lot of cost, and provide efficiency, transparency, etc. immediately. And that's the beauty, and for accessible to anybody, by the way, as well. Anybody can access those.
I do want to push a little harder, though, on the SBF comment was a little tongue-in-cheek, but right, we just saw the fall of a centralized exchange almost kill Solana. So there are huge problems with
Solana?
Solana has 4 years worth of funding left. I mean, they're still out there.
I guess my point is, what are the problems with DeFi right now, right? I think we've talked a lot about the advantages, a lot about the bright spots, but like, what are the gaps that need to be filled for this to really achieve the big time? I mean, we're still talking about a sub-trillion-dollar market. right? By the standards of traditional wealth management in large industries, this is still a toy, right? And for us to become not a toy, for DeFi to become something which is actually useful at scale for the world, there are a host of I believe, gaps that need to get filled. And I'm really curious which ones you would highlight as the ones that need to be filled in the next 12 to 24 months to actually help this thing scale in terms of value and impact.
Yeah, so the biggest gap in the space is a lack of liquidity on most assets. So if you go and look at Uniswap, and with FTX, there's this flight to self-custody, and Uniswap passed Coinbase in Ethereum volumes. But when you look at the top 20 assets and then past that, you can only trade the top assets with any liquidity depth. Past that, the systems have not yet been adopted, have not been used to create liquidity for hundreds of options, including all of these different assets, all of these different systems to actually function. So when that liquidity is established, that's the broadband moment for the space. That's when everything can start working.
So a couple of things that I think are kind of key points, and one touches on the relationship between DeFi and CeFi. DeFi is, we've built a ton of really cool infrastructure, and every time we do this and it blows up, we build more, there's more solidity to it, there's more fundamental infrastructure and girth there. But it's still not perfect. We can't go Bitcoin to ETH without some wrapping mechanisms that have their own challenges. We can't include fiat in it at all, obviously. We have stablecoin mechanisms. There's these, if we're looking for this kind of like composable, universal magic machine of DeFi that allows anything to swap for anything and total universality of collateral, all that stuff, we're not there yet. So there is some value in a layer of centralization that allows, okay, we're taking this from here and putting it back on there. I'm being very transparent about it, and a business model that sits on top and basically, abstracts away some of the technological challenges that are not solved yet in DeFi. So there's some level of centralized business that makes sense in that world. That's sort of a hack to adoption or a bridge to adoption. And the second thing is it's really challenging to not be able to understand tail risk on this. There is 10, 12%, whatever upside on yields, and this calculation of some amount of probability of total loss. And that's really hard to model when you look at it in kind of a traditional type of mindset. So there's stuff like DeFi insurance, there's ways around it. Eventually, I think we'll all get to smart contract risk being very close to zero. But in the interim, there's these outsized idiosyncratic losses that people are not prepared to understand until we have a lot more data, and we're actually generating a lot more data on it right now. So there's a couple things like that are still waiting for prime time, and there's a role for centralized businesses to play in creating real value propositions that sit on top of this incredible technology.
I'd add one more thing on like the pitfalls or the growing pains of DeFi. Two things. One, the UX is kind of terrible. Grandma can't use DeFi. She knows how to call Fidelity, but going to Curve, not gonna happen, so like something like that. The other is there's a lot of things that occur off-chain, like enforceability of like underwriting loans and things that are difficult to bring on-chain. DeFi is doing our best effort to bring that forward, but it's gonna take time.
I'd like to chime in real quick. I think it's also, DeFi is a fascinating technological innovation that I think is going to change the world. It already is. But we also still must remember the key risks when lending or when providing liquidity. When you're lending on a DeFi protocol, and if there's no collateral, if you're lending dollars and you're not receiving Bitcoin in that collateral in that protocol as collateral, there's a systemic risk to that loan. All right, you're lending dollars unsecured. That's a major risk. If you're providing liquidity to a DeFi exchange, there's impermanent loss risk, which means you might end up selling too much. Let's use Bitcoin, for example. You're selling too much Bitcoin, you're not buying enough back, so that means you're selling all your Bitcoin while the market is rallying. That's impermanent loss. These are risks that must be understood by anyone who's going to participate in a DeFi protocol, despite the technological innovations and really the transfer of risk from human error to code error. Those risks still remain the same.
Thanks, guys. I think we're getting close on time, so I think maybe as a lightning round, since everybody here is actively working in this space, I'd like everyone to just very, very briefly, you can see how much time we have, state one thing that you're working on that will contribute towards solving one of these problems in a way which you believe would be substantive. Why don't we just go down the line?
Sure. We actually just did an announcement today for something called Yield as a Service, which is basically an analytics framework that looks across CeFi, DeFi, CDeFi, and TradFi All we're looking at is expected losses and expected mitigants. That's all that really matters in the end. There's a million different ways to isolate those numbers and effectively mitigate them. But there's a next generation of yield solutions that's coming out of all of this chaos that really looks at the full transparency, the real yield, where it's coming from, how it's properly mitigated, and ultimately providing a more comprehensive suite of technology solutions around V2 of yield, because we've seen V1 of yield not work out particularly well.
We just created Ichi vaults. That's ICHI, ichi.org. These vaults enable liquidity on any token in the space. We've launched, it's working with a few dozen. We'll scale into the hundreds this year.
Trusticians is working on providing Bitcoin productivity. The way we see it, Bitcoin is great as a base layer, and you can build on top of it as the most decentralized blockchain to exist. One item we are building is called Zest Protocol. It's the first Bitcoin DeFi lending market with native Bitcoin, everything going directly through Bitcoin smart contracts and such.
We've built 2 protocols. One is Truflation.com, truflation.com. We calculate the real inflation using modern Web2 technologies, but put that on the blockchain so that smart contracts can read what the cost of living really is. And we've built Nuon.fi. Nuon is a protocol that allows you to build basically a synthetic asset pegged to the cost of living. So you have a flat coin, which is a stable coin pegged to the cost of inflation.
Risk management. So risk management and yield go hand in hand. I talked about if you own Bitcoin, you can sell a covered call against that Bitcoin just like you do with your stock portfolio. You're selling optionality. Someone has the option to own your asset at a higher strike price. They pay you a yield. Now, what do you do with that yield? You can put it in your pocket and you've got your yield, or you can use that yield to finance protection. Selling a call option to finance the purchase of a put option. I'm long Bitcoin, I sell a covered call, I generate yield, and I take that yield and I finance protection by buying a put option. That is a very interesting way to take yield and follow through with risk management.
And I'll just say Bril spent the last year doing something analogous, which is working with some of the leading risk modelers in traditional finance to translate best practices approaches to a permissionless context and put that into a platform where it's much easier for people to see the risks associated, to your point, with your position, and also to access a broader variety of strategies without having to go to multiple different products. So hopefully, I think, my takeaway here is that risk management and solving the UX of problems that we have by kind of defragmenting the space and making it easier for people to kind of engage with this without going through the mumbo jumbo that has made it very difficult to scale is going to be the key thing, along with maybe connecting to the real world and letting people use DeFi on top of real assets with real value. Imagine that. That will drive the next generation of decentralized finance. And I think it's just worth ending there on that high note, because right now I think in this market you have to be building for the future, and you have to be thinking about where do I create fundamental value rather than a short-term narrative that creates some kind of token price bump.